Welcome to the January Spotlight on Investments, brought to you by ProducersWeb.com. I'm Paul Wilson, and in this broadcast we'll cover some of this topic's biggest trends and most insightful research. This Spotlight on Investments is sponsored by Gradient Investments, LLC. Finally, experience on your side. For more information, please visit gradientinvestments.com. U.S. banks with compensation plans that encourage risk-taking would be required to pay more for deposit insurance under a plan proposed recently by the staff of the Federal Deposit Insurance Corp. The FDIC board will soon vote on the preliminary proposal, which would encourage pay structures tying banker pay to long-term performance, as well as including clawback provisions, to recover payments based on unrealized results. On the other hand, banks with risky payment schemes involving large cash components and incentives for short-term results would be required to pay more in premiums. The proposal is not guaranteed to translate into rulemaking and would not seek to impose a specific level of compensation. In addition, it would not require banks to provide more than a minimal amount of data. According to FDIC Chairman Sheila Bair, quote, "We're not talking about levels, notwithstanding my dismay. This isn't about levels, this is about structures," unquote. Research from Russell Investments indicates that 80% of fund managers expect the stock market to continue climbing in 2010. However, 19% believe stocks are currently undervalued, compared with 72% who felt the markets were bargains just last year. 72% of large-cap managers surveyed in Q4 were bullish on the market, up from 55% in the third quarter, and 54% of small-cap managers were bullish, down from 57%. Finally, the company also reports that enthusiasm for corporate bonds fell from 44% at the end of the third quarter to 27%. Despite improvements in the economy, life insurers' investment portfolios face a tough road ahead, according to a recent report from AM Best. The rating firm's report found that the top 16 publicly traded U.S. life and annuity carriers saw a profit surge during the third quarter of 2009, earning approximately $1.51 billion in net income. In addition, net realized losses fell to $5.02 billion for the period. However, commercial real estate loans, property holdings, and commercial mortgage-backed securities continue to pose a risk to carriers, complicated by the recent stretch of economic weakness and low interest rates. Finally, the report found that carriers have minimized their exposure to alternative asset classes in order to guard against volatility. They have also placed a high priority on liquidity by raising positions in cash and short-term investments. I'm Paul Wilson, and thanks for watching the Spotlight on Investments. To see more video spotlights on your favorite products and practices, find them on ProducersWeb.com and browse by topic.